Okay, everyone, I think we'll go ahead and get started. I'd like to welcome everyone to today's BI Energy Exchange, where we talk about our research and the latest development in the markets. It's been a very interesting last few days, particularly with all of the news flow related to OPEC. Apologies for that. Uh, Sally, I want to turn to you first to talk about the latest OPEC meeting. Give us a sense of what happened, what you think is next, and how important is the cartel going to be on a 5-year basis?
Sure. Thanks, Rob. I mean, it's, as you said, definitely interesting times. If you asked me last week before the meeting if this is what was going to happen, I wouldn't have guessed it. I don't think many people would have. Because what's happening is, at the core of it, is a disagreement between Saudi Arabia and the UAE. I mean, historically very close allies within OPEC and outside of OPEC. And the disagreement is about the UAE's quota level and how the baseline that was set for them may have been a bit unfair for them when this agreement was first put together last year during the pandemic. So, I mean, one of the reasons for this is that, like, when this deal was put together, obviously the oil market really needed this supply management, this strict supply management, and the UAE, even though it knew it was spending quite a lot of money to expand its capacity, it had to come to a compromise and it had to be part of this deal, and they did. And late last year, we did see the group raise this issue of quotas and how it may be unfair for them for the first time, and they actually even floated the idea of leaving OPEC. So it's not too much of a surprise that they're raising this issue again now. But what's kind of surprising is that they've done this kind of in a public spat kind of way and not behind closed doors with Saudi Arabia, which is very interesting. And I think it's, I mean, call it threatening or not, I'm not sure. But I think the chances of the UAE leaving is still slim, I think, but definitely higher than before. But when we look at the rest of OPEC and OPEC Plus, they seem to be in agreement of what's next. The group should continue to bring back more barrels back into the market as demand continues to slowly but gradually improve. And this, I mean, I must say, this is starting with 400,000 barrels a day in August and doing the same for the rest of this year. This was something the UAE agreed with as well. What they didn't agree was extending the end period of this agreement from April next year to the end of next year. So that's kind of the first part of your question, what's happening.
And Sally, do you think that Saudi Arabia and Russia effectively need the UAE? Like, how important do you think their participation is in the group? Does it fall apart if they walk away?
I mean, it's an interesting question. I don't think it would, but I mean, there's a catch. So the rest of the OPEC Plus group alliance would probably stay in place, and they would probably continue with some sort of supply management. But bear in mind, at the crux of the issue, right now, the UAE is about 1.2 million barrels a day below its new higher capacity. So if they do leave and they go at it themselves, that is another more than 1 million barrels a day of oil output coming back into the market, which is significant. I mean, we've been on this call as well, we've been talking about Iran coming back and how impactful that could be. And that would be about 1.4 million barrels a day in itself. So, I mean, this is significant. I mean, I think if it happens, the group will probably stay in place, but then we would see this unexpected amount of barrels coming back into the market at a time where, I mean, we always talk about how tight the market is at the moment and perhaps for summer, but looking beyond this very near term and beyond this seasonally strong summer period, we don't know what's going to happen with demand. And another million plus barrels per day of output would be a problem for the market.
Well, but at the end of the day, isn't there plenty of supply? It's just artificially constrained because of OPEC Plus, or do you see it differently?
No. I think that's correct. I mean, I think the price, oil price we're seeing at the moment is an artificial oil price, right? And I mean, the plan with OPEC has always been that they are keeping a significant amount of supply offline just so that the market is some sort of a balance, and then they're monitoring the market, they're gauging the market monthly, and as they see demand improving, they gradually bring this output back. And for August, that amount was going to be 400,000 barrels per day, and they would kind of continue to monitor the market and bring some more. But I mean, if they were to, I mean, I think this is a very low likelihood, but if the alliance were to dissolve and they went back to pump at will kind of policy, I mean, there is just too much supply that they're keeping on the sidelines. And if that were to come back, that is a big problem and very bearish for the oil market. But again, I think at the moment, as things stand, I think that is still a low likelihood.
Okay, very interesting. We've got Elton Mamadov and Will Hares both on. We're going to bring them on in turn. So I think a natural segue is to think about the read across for the gas market. Now, clearly different dynamics, but we've seen a big run up on European gas prices as well. Elchin, what's going on there? What are the factors, and what's your 3 to 6 month outlook?
I mean, yes, as you said, we've seen quite a steep rise in gas prices in Europe, but also more globally as well. The stronger oil market does help a lot because some contracts, especially in Asia, are still indexed to oil with a certain lag. So that definitely helps to have a higher and rising oil price. However, the big factor, another big factor causing the gas prices to surge in Europe is the fact that Russia's Gazprom seems to be limiting or not willing to increase the transit capacity bookings. So there's plenty going through Ukraine and elsewhere in Europe, and Gazprom just decided not to use them to increase supplies to Europe. And that obviously pushes up the price. We think the key driver for that is the fact that Gazprom does want to put pressure on the Europe and the US to give a green light to the completion of Nord Stream 2 project that we think will be completed next year. So that's one way we think the European gas prices are artificially high now. We do think that there is more downside to gas prices now that they've reached such high levels. So yeah, on the 6 months horizon, we do see them coming off slightly, especially due to the fact that demand is eroding at the moment. Coal is having a tremendous comeback in Europe in power industry just because gas prices are so high. So there's a gas to coal switch happening now. So yeah, it's we don't think it's a sustainable situation, and that's why we do see downside to gas prices in the next year.
Elchin, this is just a stunning development to hear about coal coming back in Europe. So for those who aren't following, you mentioned the gas to coal switching. How's the carbon price playing into that? We've seen a big rally there as well. You've obviously got the underlying commodities for coal, gas, and carbon all interplaying with each other. But yeah, what's the carbon side of this equation, and how's it affecting the gas market?
Carbon price seems to be hitting new records again recently, and you would expect that to curb coal generation. But again, as I said, because gas prices are rising much faster than coal, we are seeing this coal to gas switch in power. Plus, last year during COVID, coal suffered much stronger than gas, so it's easier for coal to recover. But yeah, the rise in carbon prices we've seen recently is on the back of upcoming reforms that are due to be formally announced in mid-July, 14th, I think, but also due to the fact that the gas prices are rising so much that there's more demand for coal in power, and if there's more demand for coal, there's more demand for carbon permits. So now carbon price is driven by gas rather than the other way around. This is the trend we're observing.
Fantastic. Okay, so hang on, Elton. We'll probably come back to you in a second here. But okay, so you've got an oil rally, you've got a gas rally, you've got a carbon rally. How does a company like Shell think about this? I know you've got a React out on the company this morning talking about their recent announcements. So tell us about the React and tell us about their view on kind of how these markets are going to unfold over the next 6 to 12 months in your opinion.
Yeah, thanks, Rob. So Shell announced this morning that they would begin their shareholder distribution plan. And this is earlier than expected, than we expected, and I think most of the market expected as well. It was conditional on the company achieving their 65 billion net debt target. And for those that follow the company would know that the company has struggled in the last several years to bring their net debt levels down, particularly since their acquisition of BG Group back in 2015. And of course, most of their peers have also struggled as well. But Shell has really lagged the rest of their peer group with recovering their shareholder distribution and buyback plans from the beginning of the pandemic from last year. And so this should be seen as a very encouraging sign for particularly the company's free cash generation this year, and management even went out to identify that the improving commodity backdrop was an obvious key factor in this decision. And so with this free cash generation, we expect the company to improve their buybacks, mostly more so than their dividends, but also start to use this capital to develop their low carbon businesses. They've been talking more about this recently, and particularly given that we're seeing a big acceleration among the European majors to expand their renewable power generation footprint, their EV charging, batteries, really full spectrum across the energy transition businesses. So we really see this improving commodity backdrop as benefiting all within the oil sector. Particularly these oil majors, which have cut capex quite a lot in the last couple of years in response to the pandemic, and so they will be generating an enormous amount of free cash, and we're going to start seeing that be deployed in a very different way than we may have seen historically for these companies.
Now, Will, this is a great fundamental question for the oil industry right now. You mentioned great free cash flow from the commodity boom that we're seeing right now. And yet the company, Shell in this case, is talking about a very different investment pattern going forward. It's not as interested, I think, in doing as much investment on the pure upstream side of the business. It's diversifying into all the clean stuff you just mentioned. So I want to get your sense. What is the right mix? Because I think we're in a period right now where some folks within the oil community are looking at the higher prices we're seeing right now, and they're worried about underinvestment. So how do you balance that out when you think about particularly like a company like Shell or any of the other integrateds?
Yeah, it's a good question, and I think the key factor in this is ESG pressure and sustainability and climate risk for these companies. So clearly, the European majors are subject to much more intense investor pressure on an ESG front than, say, their American peers, and so that's in part why we've seen the European group leading their American counterparts on some of these issues. So it's not actually that surprising to see not necessarily just lower capex, but just lower targeted growth. And there's been some talk among the Europeans of starting to decline oil production in the near term. So this is really just a signal from the management teams that where they see their share of the oil market starting to decline. But as I mentioned earlier, this really opens up a gap in their financial framework to be able to start establishing this footprint in energy transition businesses, which they clearly see as being a big part of their businesses longer term. And I think this is really well reflected in Equinor's Capital Markets Day, which I talked about a couple of weeks ago on this call, where management has said that they plan more than half of their Capex by 2030 will be low carbon or renewable oriented. This is the largest of any of the majors to date that have disclosed a target like this.
Now, Will, I want to react to what you just said about the idea that perhaps the integrated see a future where they have lower market share. So conversely, Solly, let's bring you back on. Solly, are the OPEC member countries, the national oil companies, and those associated with the various players, are they preparing to expand market share perhaps in this future? Are they investing enough? How are they looking at the Western oil majors, and when they see them investing in renewables, do they feel the pressure to do something similar? Or are they very comfortable being in the oil lane for right now?
I think that's a very good question, and I think it's a little bit of both. I think just in general, OPEC countries are definitely starting to see this trend that Will has been talking about, and definitely seeing this room for them in the next decade or so to step in and increase production and grab that market share that they've lost over the last few decades. So this is partly why I think you see ADNOC, and we talked about the UAE and why they want to go back to producing more. They have been spending quite heavily to increase their capacity. And I think, when we look at Aramco, is another good example where it is increasing its capex quite a bit this year compared to last year, which was revised down quite heavily due to the pandemic. So I think when you look at these NOCs, they're definitely seeing this room for them to come in and produce more and fill that gap that is going to be coming from the international oil majors. And this is why, when we talk about call on OPEC, which is how much crude the world needs OPEC countries to pump. And this was a question that we asked in a Bloomberg intelligence survey recently as well. And majority of the people do expect this amount to be higher in the next decade. So there's definitely this opportunity for them. And I think they're coming to grab it. But then when you think about the energy transition, I think these companies are also starting to think about it more and more as well. And perhaps not in terms of renewables, but we are seeing them kind of give a bigger chunk of their capital spending to things like chemicals. And this is why I think, for example, a company like ADNOC and the UAE want to increase production and want to increase their cash generation because they do have plans to increase their petrochemicals capacity. And similarly with Aramco and with its SABIC acquisition and expansion plans, they want to do more with their own crude and kind of expand into petrochemicals, which is their way of kind of going forward with the energy transition. So definitely thinking about this as well, perhaps not in exactly the same way that the EU oil majors are thinking about it, but they're very much looking at this very closely, I think.
Okay, so with the idea that we may have some expanded opportunity or scope for some of the national oil companies to bring on new supply, expand market share in the future, I want to flip to Elchin and ask the same question, but on the gas side. So particularly here in Europe, how reliant are we on Russian gas at this point? Are there other opportunities for LNG supplies to come from other parts of the world? So what does that sort of more political dynamic question look like on the gas side, Elchin?
For Europe, I wouldn't worry too much about our energy security. Obviously, we are relying on Russia, and the Gazprom's market share in Europe is probably going to increase slightly over the years as local production in Europe declines. However, we do have a very varied sources of gas, especially, for example, coming from North Africa. We have seen a tremendous increase in North African supplies. However, they're not too reliable, and as we see increasing demand for gas in places like Egypt and and Algeria coming through, we do need to see, okay, what are new sources of supply? Potentially contentious issues, but some from East Med, like Sally's written a big report on that, could be a potential new source of diversification. Europe is investing in hydrogen, which is kind of another way of reducing reliance on Russian gas, but the volumes are minuscule for the next 5 to 7 years anyway, and so we will need Russia to be there. However, some countries like Germany are building new LNG import terminals. Others like Poland are thinking of expanding them. There's new terminals in Southern Europe, like Croatia, for example, are coming through. So there will be more LNG terminals. We will import a lot of gas from Russia in terms of volume, but the role of Russia in Europe's European gas market will be limited by the fact that we do have an option of buying more expensive LNG. So yeah, it's quite an interesting situation. And obviously Nord Stream 2, we've talked about it a lot, but that will further, increase our reliance on Russia.
Thank you, Elchin. Okay, so I want to switch gears a little bit and come back to something that Will said a few minutes ago. And Will, you mentioned ESG pressures. So I think probably everyone listening, whether on social media or elsewhere, you've probably seen in the last week the very stunning video or pictures of the vortex of fire in the Gulf of Mexico associated with operations by Pemex. Is this kind of thing going to shift any of the conversation in the near term on ESG? I mean, obviously, it's already a pretty big factor for the companies here in Europe, but do stunning images like this have any effect on whether we're going to continue to pursue new upstream investments in North America or elsewhere? So we'll start with you, Will, since you brought it up.
Yeah, so I mean, it's interesting. I think I would take a bit of a different angle and say that the fact that this video of this industrial accident went viral is a reflection of the current public attitudes towards oil and gas production, particularly offshore oil and gas production, which to nearly everyone is an extremely hidden industry that nobody really gets to see how the sausage is made, so to speak. But I think maybe it's a bit of an unpopular opinion of mine, but of course the images were pretty dramatic and clearly distressing. But what happened was it was a rupture of a gas pipeline that was fixed within 5 hours. So the gas burned off, and is clearly a bad accident. But I guess if these images are contributing to increasing public concern around global emissions and their contribution to climate change, then perhaps that's the silver lining to this event. But I would hope that most people's concern would also come from the fact that many consumers' activities, at least within the developed world, are derived from that sort of production, and our energy needs, as it stands right now, are still heavily reliant on fossil fuels, and so that's my take from that little viral video and of the gas leak in the Gulf of Mexico.
Sally, so reacting from Will, I think that it really raises a question about demand. So in some sense, you think investment will occur to rise to the level that consumers around the world are demanding based on the types of decisions that they make. So how quickly could we end up in a world where we need less fossil fuels? I mean, I think that most of the national oil companies, OPEC members, are planning for demand continuing up and to the right for the foreseeable future. Do you see any potential stumbling blocks to that thesis, and how quickly could we see a different demand picture start to emerge that would lessen the need for some of these type of investments at some point in the future?
I mean, the short answer is I don't know, and I don't think many people know. But I think that one of the most extreme scenarios that we saw recently in the last few months is the IEA's net zero 2050 scenario that we talked about a couple of times, I think, on this call as well. And there, obviously, they do see demand peaking already and kind of going down quite significantly from here onwards. Again, and most of the, I think, base case scenarios for majority of the agencies is that it does go back to the pre-pandemic level. It goes up even more before peaking, which is not anytime soon. I think our base case scenario is somewhere in between. And I think a few things to mention is, especially coming out of the pandemic, and we are seeing all these headlines, especially for summer, demand is improving, especially in the developed parts of the world, but it's improving from a very low level. And we do believe in our base case scenario that there will be some structural changes to demand, which will make it really struggle to kind of quickly get back to its pre-pandemic level, if ever. And I mean, we are watching things like the acceleration of EV adoption globally, the fuel efficiencies that we continue to see. We are watching the teleworking and what it means for oil demand, and kind of the return or lack of full return of business travel, which is quite paramount for the jet fuel part of oil demand. So I think these are all important things that we need to keep in mind on how oil demand moves from its pre-pandemic level. And again, I mean, how much these type of incidents impacted, it's very difficult to tell. But I think it's also important to note about what this IEA net zero scenario had already said, was that there would be no need for oil and gas investments into new fields. And I think one thing we need to keep in mind about this is that goes along with this demand scenario of demand just kind of falling from current periods. But if it doesn't, I think we would need kind of more investment compared to what IEA envisages in its net zero scenario.
Okay, thank you, Sally. I think we've really hit this battle between fossil fuels and this increasing paradigm about doing more clean energy renewables. But one component we really don't talk about on this call very often is nuclear. And so, Elchin, I'd like to close us out here with just some brief thoughts from you on the nuclear industry in general, the potential for them to play a role in a cleaner future. I know it's not quite a strategic question, but I know there's been some news flow on EDF lately. So tell us about nuclear in general and tie it back to your thesis on EDF as well.
I mean, the short-term future of nuclear is positive. I mean, EDF has just upgraded its outlook for 2021 nuclear output, and we think the company will also upgrade its outlook for next year. So in the short term, things are getting back to normal, especially as demand recovers from COVID. The companies are finally going through the backlog of maintenance that were pushed back because of COVID. So in the short term, it looks good. In the long term, it looks very mixed because EDF is the biggest developer of nuclear in Europe. And outside of that, very few companies want to touch nuclear at all. So it's mostly financed by the government. And even EDF is a government owned. However, in order for EDF to be able to invest in nuclear effectively, it needs to, France needs to overhaul the company. Unfortunately, to do that, it needs to get an approval from the Brussels in order to make sure it's kosher with EU state aid rules. And the Brussels pushes for EDF to be broken apart, and otherwise it will retain competitive advantage against other companies, while French government and EDF unions strongly oppose this. So we are in a bit of a deadlock at the moment. It will delay many investments in nuclear. However, just to bring some more positivity to nuclear, UK government is expected to announce in the coming months the new framework for making it easy to invest in renewables. So we will see sizable C being built in the UK. It's a major new nuclear project by EDF. So there are some positives. However, we don't see in Europe and in many other countries nuclear playing a big role in terms of new capacity, new CO2-free capacity. So yeah, we do expect renewables plus storage to be the major driver of that.
Okay, thank you, Elçin. That's great. And I want to thank everyone for joining us today. We hold these calls on the first and third Wednesday of every month. So spread the word. Please join us next time. And in the interim, reach out if you have any questions. Find all of our research on BI Go, and I hope you have a great rest of your week. Take care.